Hey guys, welcome back. Patrick here. In this video, let's talk about Hippo Holdings, ticker symbol HIPO. This is my first video from Canada, so pardon me if the setup is a little bit ghetto for now. Just set up my lights, so hopefully the lighting isn't too bad and you can hear me correctly. But today I want us to talk about this one. This is a play that comes from Ron, one of the members of the group, and I looked at it. I figured, hey, it's not that bad, so I opened a position too, and now I'm telling you guys so you can look into it, figure out how it works, and decide for yourself if you think it's worth trying it. All right, so Hippo Holdings used to be a SPAC, an insurance company, and now today it is down 15%. So 15% is a pretty big drop for a company that's only worth $435, right? But you guys are pretty used to it at this point. SPACs are toxic, and not only that, they have all sorts of catalysts like the warrants, the PIPE lockout, or lockup period expiring, and things like those. So a move of 15%, you'd be like, well, what really happened? Like, did they miss on their earnings? Or was there a big sale from one of the owners of the company? Like, what are the negative news? Well, really, there's nothing. So this is based on market forces, including probably PIPE actually selling or hedging their position, or something like that, right? So there's no real reason for this stock to crash 15% today, and that creates an opportunity for a rebound. Kind of like what happened with Catapult recently, which was another play that's been extremely successful. All right, so you guys can look into it. This was a SPAC, so it was stuck at $10 for a long time, and then after the merger, it totally collapsed all the way down to $4. All right, so kind of like Play Studios, Catapult, and other stocks like those. Now, in the past couple of weeks, you guys know that there has been sort of a rebound along with the Russell 2000, and a lot of the small cap stocks have rebounded, kind of, including this one. If you notice, it had gone from $4 all the way to about 550-ish, right? 547 is a high on this day. And now today, a big drop of 15%. All right, so going forward in the video, keep this number in mind, $3.99, because when I tell you the different ways to play the stock and what I decided to do, the $4 is going to be very relevant. But first, let's take a quick look at the earnings. Like, is there something that they released recently that would give us a lot of red flags about this company? Well, there's a real mixed bag. I mean, let's be totally honest. This is a company that's not doing that well, right? So their revenues are actually up nicely. If you notice, in the second quarter last year, they had made 12 million in revenues. Now this is bumped up to 21 million, and the company is generating a lot of premium, right? And they have 88% retention of their customers. So this is fairly good. The company itself is growing nicely, and they're in growth mode right now. But here's the problem with it. Right, it's when you look at it, the bottom line. Do you guys remember when we analyzed the earnings for a lot of different companies lately, like Proterra, and there were big adjustments based on the warrant liabilities, and it made it so the companies looked like they were losing tons of money. Same for SoFi, right? Well, this company is exactly the same. Look at this. Net loss was 84.5 million, or $5.98 per share, compared to last year 24.8 million. So when you look at that just at a glance, it looks like the company is getting absolutely crippled, right? And that's one of the reasons, in my opinion, good reasons why the stock dropped from $10. Right? It's not really a $10 stock anymore when they have big losses like those. Now, you have to keep in mind that a lot of this is based on the warrants being considered liabilities when they weren't before, when this company was underwritten. So, you know, it's kind of like a mixed bag. It's not a real loss of $6 per share, right? Now, the next thing you need to look at, and this is very important for insurance companies, is the loss ratio. And again, this is fairly negative for the company right now. They're not doing that well. If you notice, the loss ratio this quarter is 161%. That is, they're paying out more than they're collecting in premium, And that obviously is not the way to go when you're an insurance company, right? So last quarter of last year, it was 106%. So the company is not generating enough premium for the amount they're paying out, and they're using inclement weather in Texas as a reason for that. You guys know that there's been a lot of hurricanes and hailstorms and a lot of inclement weather in the past few months. Well, they had to shell out a ton of money to people that were insured through Hippo, right? So now you might be thinking, and that would be a great question, that's the next thing that I've been looking into is, well, Patrick, then like what about Hurricane Ida? That's going to create a ton of problems for the insurance companies. Great question. So then you want to look at the other insurance companies, and Lemonade is actually up today, right? So up 0.57%. So it's not all insurance companies that were knocked by 15% today. And that's what leads me to think that Hippo, right, it's just the market forces from, as we talked about earlier, they have the PIPE investors, there's the warrants, there's all these considerations linked to being a SPAC. Then we also have the expenses for the merger. So all of that causes a lot of negative points to the company that is not necessarily based on the full industry. Lemonade's not down 15% today. With this knowledge in mind, how can we actually play the stock successfully and make profits? Well, there's 3 different options. I'm going to show them in different scenarios. First, you could be buying shares and hoping that the stock actually rebounds. But here's the problem with that. I don't really believe in the stock. I don't want to be into it long term. And worst case scenario, if the shares are actually going down and I'm wrong about this stock, well, I don't want to be back holding this company for the next 3-5 years as they keep paying more and more than what they collect, right? Especially with Hurricane Ida in the next quarter, they might be taking big losses and everything. So because of that, I don't want to be in this stock long term. I don't want to get married to it. I want to do a short term play. So shares are out of the question for this stock, in my personal opinion. Now, what about buying call options? That's the other play that you could do on this one. But buying options is like tricky because not only are you paying premium, then you have to face time decay, and also I don't know how quickly it's going to rebound. Is this stock going to rebound to $5 next week? Is it going to be in 2 years? I honestly don't really know. Right, so personally, you guys know at this point that I prefer selling options than buying options. I feel like everything is in your favor when you do this. Let's say that I bought options on this. Well, my break even is going to be the current strike price, where you buy it, plus the premium. So let's say that I buy 450 strike price options, then I would need the stock to go up fairly rapidly for me to make a profit. But then that leads us to the third option, which is what I prefer, is to actually sell put options on this one and be out of it as soon as possible, thinking that this is oversold, right? But as soon as I can, I'm going to close it, capture my profit, and get the heck out of this play. So this is what it looks like. If you look at it, Ron had initially opened his position in January, but then when we talked about it, I personally opened it in October because I feel like it makes more sense. I don't want to be in this stock for 5 months, and especially through the next earnings, because if the news are bad, if they're paying out a lot because of the hurricane, then the share price might crash even more than at 439. So I personally went with October 15th. You guys can actually look at it if you want. Then I was looking at different strike prices. Well, remember, when we look at the chart, this is a stock that never went under $4. It stopped at $3.99 and then it rebounded. So this is not necessarily the strongest support ever, right? But it gives me something to work with. I decided to go with the $4 strike price, and that's going to be my support for now. The stock needs to go way under $4 for me to start taking losses in this play. So the risk versus reward is very, very good. If you look at it, right, currently the bid and ask are 35 cents and 50 cents. There's been a lot of volume today, almost 1,500 contracts. I personally opened 20 contracts at $4 and I received 45 cents each. So how does that work out? Well, what you do is you do $4 minus 45 cents. That's going to be your break even. And in this case, it would be $3.55. So as long as the price doesn't drop under $3.55, I'm going to be making some profit on this play. If it stays above $4, I'm going to be collecting the entire profit. Right, so as you can see, the benefit to selling options rather than buying options is that I don't need the price to go up. Whether the price is flat, right, between now and October 15th or when I close a position, or even if it comes down a little bit, I may still make profits. Even if the stock goes to 380, I'm still going to be making profits. And that's why I like selling options rather than buying options. Anything above 355 is going to be profit, and where is it going to go, right? If the stock goes to 325, then I'm going to take a little bit of losses, but nothing that's going to really cripple my portfolio or anything. The stock would need to like really tank to $2 without me touching it, without me like adjusting it, closing the position, or doing anything for me to really suffer from this play. Right, so that's why the risk versus reward is really, really good. Now, if you calculate the numbers, think about this: 45 cents times 2,000, right, and then you divide that by $4. This is 11.2% potential profit on this stock, on this position. Well, where else are you going to get that in the stock market, right? Where can you get 11% in 1.5 months? Almost nowhere. So that's how, yes, this is a little bit riskier, but the potential rewards are also very, very strong for this play. So I hope you guys enjoy it. If you want to join the Patreon, it's a new month. You can look in the description. We've had very, very good success over the past few weeks. A very, very good group. So if you want to check it out, link in the description, and I'll see you guys in the next video.